We turn now to the capital asset pricing model. In 1962, a young PhD student was looking for a topic for his dissertation. Bill Sharpe approached Harry Markowitz to discuss his work in portfolio theory and in 1963 published a simplified model of portfolio analysis. Sharpe argued that all securities had a common relationship with some underlying base factor, maybe a stock market index or gross national product (GNP). Sharpe argued that an analyst need only measure the relationship of the security to the dominant base factor. This, of course, greatly simplified Markowitz's work. So for common stocks, the single greatest influence was the stock market itself. Secondary factors were things like industry groups and the unique characteristics of the stock itself. If the stock price is more volatile than the market as a whole, it will make the portfolio more variable and therefore more risky. If it's less volatile, it's less risky. Now, the volatility of the portfolio could easily be determined by the simple weighted average volatility of the individual stocks. Sharpe named his volatility factor beta. Beta measures the degree of correlation between the movement of the stock market as a whole and the stock price of the individual stock. Stocks that rise and fall directly in line with the market have a beta of 1.0. If the rise or fall is twice as fast, then the beta is 2.0. And if its movement is only 80% of that of the market, then it's 0.8. Taking a weighted average of all the betas of stocks in a portfolio, above 1.0 suggests that the portfolio is riskier than the market. Below 1.0, the portfolio is less risky. In 1963, Sharpe followed up his work on portfolio theory with an extension of his model, and he called it the Capital Asset Pricing Model, or CAPM. Now, he identified that stocks have two distinct risks: market risk, or systemic risk, and unsystemic, or company-specific risk. Systemic risks are market risks that cannot be diversified away, things like interest rate changes and recessions. But unsystemic risk relates to the individual stock and can be diversified away by compiling a portfolio of different stocks. What we need now is to understand how we can tie these theories into the market itself. And to do this, we'll turn to a young assistant professor of finance at the University of Chicago, Eugene Fama, in our next lecture. So that's a quick introduction to the origins of the capital asset pricing model and its key factors, particularly its reliance on beta and price volatility to measure risk.